Welcome friends. We have seen how to get the capital gain or capital loss and the tax adjustment being done and after tax the cash flow from the sale of an asset. Now we will see the adjustment of free cash flow. Your free cash flow, see till now go for the free cash flow in your mind. What we have done, we calculated the incremental earning by deducting the expenses from the incremental revenue minus incremental cost is gross profit minus selling general administration minus any research development minus any depreciation. Then it gives the EBIT minus tax gives the incremental earning. So the incremental earning added with the depreciation, deducted with the initial investment, adjusted with the change in the net working capital, gives you the free cash flow. And once you get the FCF or free cash flow, you use the NPV, IRR or any method to calculate the project is profitable or not, evaluate the project. Now, adjusting the free cash flow. Some other abnormal items might come, which is to be adjusted in the free cash flow. What might be those items? Let us see. One is tax loss carry forward or tax loss carry back. How it happens? All corporations to take losses during current year and offset them against gain in nearby years. We have discussed this many times. Tax and earnings are opposite in nature. If EBIT comes positive, tax comes negative. If EBIT comes negative, that means loss, then tax becomes positive, that is a tax credit, which will be adjusted in the future tax payment. So let us see how it happens. For a replacement decision, often financial manager must decide whether to replace an existing piece of equipment or continue the existing one. The new equipment may allow increased production resulting in incremental revenue, or it may simply be more efficient, lowering the cost. Either of the two or both of them might happen, isn't it? Number one, once you replace the equipment, it may increase the revenue. Option number one, it may increase revenue. Increase production, increase revenue, number one. Or it may simply reduce the cost. It may not increase any revenue, but it will reduce the cost. That also equal to increasing the revenue, isn't it? So either the new replacement might increase revenue, increase production, increase revenue, option number one. Or it may reduce cost, or it may do both. Example, you are trying to decide whether to replace a machine on your production line. The new machine you are considering will cost 1 million to you, but will be more efficient than the old machine, reducing the cost by $500,000 per year. Your old machine is fully depreciated, but could sell it for 50,000. You see now, here is the turning point. First one, you can spend 1 million for replacing the old machine with a new one. The new one will not increase production. The new one will not increase sales revenue, but it will reduce the cost. It is efficient one. Reduce the cost by $500,000. Spend 1 million and per year $500,000 you can save. And at the same time, the old machine is completely old, it is depreciated, gone. And you can sell it at 50,000. You would depreciate the new machine over a 5-year life. See, you will spend 1 million, you have a 5-year life for this new machine. On markers, you can depreciate on 5 years life. The new machine will not change your working capital needs. That means the machine is so efficient, it doesn't need any new working capital. No need of new working capital. The existing working capital will operate. And it can save 500,000 per year the cost. or 500,000 the cost saved. And the new machine is how much? 1 million. Old machine will be sold at 50,000. It is fully depreciated. No existing book value. It's zero existing book value. So all 50,000 is capital gain. Your tax rate is 35% and cost of capital is 9%. Should you replace the machine? Question. Let us see. Incremental cost 500,000. See, if you buy the new machine, the incremental cost of the new machine will be minus 500,000. That means minus minus plus. The cost saving. Normally your cost is minus. Here it will minus minus plus because it will save cost. Depreciation schedule will be for the 1 million. The new machine is 1 million. It will be charged on markers. Markers 5 year is equal to 20, 32, 19.2, 11.52, 11.52 and 5.76. Therefore, depreciation amounts are given here. Capital gain on salvage. The old machine will be sold for 50,000. It has no book value. It is completely depreciated. So the 50,000 is capital gain. The cash flow from the salvage is equal to 50,000 minus tax on 50,000 is equal to 32,500 because tax is 35%. So 32,500 is after tax cash flow of the old machine salvage value. Now add back the depreciation, deduct the capital expenditure, deduct the change in net working capital, and make any externalities like the one we have done. What is that? With the new machine, there is no incremental revenue. Is there any incremental revenue? Absolutely no. The new machine is not increasing your revenue. So zero. But the incremental cost of goods sold is equal to 500,000 positive. Normally cost of goods sold is negative. But this is saving your cost of goods sold. So your 500,000 will be positive here. Therefore, incremental gross profit will be because of this new machine. Incremental gross profit will be 500,000 from year 1 to year 5. See, without having an incremental revenue, the new machine gave a incremental gross profit of 500,000 because of the saving in cost. Less depreciation as per the markers we have seen in the previous slide. 200, 320, 192, 115, 200, 115, 200 and 57, 600. So this is the depreciation. EBIT 300, 180, 308, 384.8, 57.6 minus. Now tax and EBIT are opposite relationship. Time and again we are discussing this. So if EBIT is plus, tax is minus 35% of the EBIT. And from year 1 to year 5, EBIT is positive. So tax will be 35% of that negative. But in year 6, EBIT is negative. So tax will be 35% of that positive. That means that is a tax credit. You can use it in future tax to reduce. Incremental earnings will be 195, 117, 200.2 to 50.12 to 50.12 minus 37.44. Dear students, this is the baseline calculation we have done. Incremental earning. Now add back the depreciation. First item. To make the free cash flow, 3 main items are there. One is add back depreciation. Second is deduct the capital expenditure. Third is net working capital, additional net working capital or change in the net working capital. Fourth, fifth, any externalities happened. Let us see them. Add back depreciation on markers basis, whatever you deducted there, add back them. 200, 320, 192, 115.2, 115.2 and in the 6th year, 57.6. So we have added back the depreciation, first adjustment to get free cash flow. Second adjustment, purchase of equipment or initial investment. You have to spend 1 million for buying this equipment. So year 0 minus 1 million. Third, change in the net working capital. In the question, it is given clearly that it doesn't need any working capital. Read it. You would the old machine is fully depreciated, and the new machine will not change your working capital needs. Second paragraph, last line. The new machine will not change your working capital needs. That means no additional working capital required. Therefore, no working capital adjustment required here. But there is a salvage value 32,500 post tax. After tax salvage value is equal to 50,000. You sell it, and there is no written down value, or there is no that completely the asset is depreciated. So 50,000 minus 0 is 50,000 capital gain. Tax is 35% on capital gain. So 35% of 50,000 is equal to 17,500. So after tax, salvage value is equal to 32,500. That will be, if it is plus, add here. If it is loss, deduct here. Here it is a capital gain. After tax, free cash flow, after tax from the salvage value is positive 32,500. Add here. Then calculate the incremental free cash flow. What we have done here, we have calculated the incremental free cash flow with some salvage value and selling of that and booking profit in that. NPV, you have the cost of capital is 9%. So it gives a positive NPV of 573.81. So accept this project. Now we will go to the last part of the discussion. Before that, let me ask take your questions and ask any doubt is there.